Hi, everybody. So here we are trying Take5 in a new format. We're going to be speaking about each of these slides rather than have you read it. Let's see how it goes. Eager to have your feedback. And I have with me Hiloni, who will partner me in this journey.
We have 5 interesting topics here for you, and we'll go through it one by one. The first slide is called India Still Catching Up to the World. Here we have a very interesting chart which shows India's per capita income in comparison to the world since 1960 to 2026.
So this is one of the most interesting charts. Whenever we see something spanning across decades, it tells a lot of stories. Here, of course, one thing is we are speaking about per capita GDP. It starts in 1960 when India's per capita GDP was $95 per head compared to the global average of $454 per capita GDP, which was only hardly 18.7% of global average. This, instead of going up like it happens for most countries, kept on coming down, down, down. And we would have possibly been somewhere close to sub-Saharan numbers now. If it wasn't for what happened in 1991. So 91, 92 is when India went through its worst crisis financially, and India had to pledge its gold to borrow some dollars to pay for its imports. It was so bad. And thankfully, that was when the government, the famed duo of P.V. Narasimha Rao and Manmohan Singh, decided that enough is enough and took a bold stand to liberalize India. And you can see very clearly that from the time these liberalization efforts took place, India's per capita GDP has only been rising, okay, to where we are now at almost $3,050 per capita, meaning per head. Okay, so let's try to explain what is this per capita GDP. It's simply put the entire economic output of the country divided by its population. So we have whatever is India's GDP in any given year divided by the number of people in India in that year gives you per capita or per head GDP. What is the importance of this? Why do we look at per capita GDP? It's a great indicator of prosperity. So if one were to see who are at the bottom of this league table, you would find some of these African countries like Burundi or South Sudan, where the per capita GDP is hardly a couple of $100. So, like what it was in 1960 for India, of course, inflation adjusted, it would be different, but they are around $300-400 per capita GDP today, and which is why we call them so poor. But what is good to have? So, good to have, we can have different measures. It is said that, when IMF and World Bank speak about per capita GDP, they say that once you cross $1,000 per capita GDP, then your basic needs are met. So as the per capita GDP goes up beyond that and prosperity increases, it means that we are going to be spending more and more on consumption and savings.
Which we have been seeing in India in the last few years.
Absolutely. So consumption growth has been very good. Savings growth has been excellent.
Yeah.
The other point to look at is where are we in relation to the rest of the world? Yes, we are at 3,050 today, but the country we think we are competing with, which is China. Is at $18,000 per capita GDP. They were at this level in 1998. Where India is now, China's per capita GDP was the same in 1998. So we have a long way to go. Both are populous nations, right? So unlike comparing with a country like, say, Luxembourg, Luxembourg's per capita GDP is like $146,000 per head. So you might ask, how can a tiny country have such a huge per capita GDP? It's just because it's tiny.
The number of dividing population gaps.
The denominator is so less. Luxembourg's population is hardly 7 lakh people, less than Janagar. Given that countries like Luxembourg and Switzerland have very huge numbers, and US is somewhere around $80,000 per capita. A large country, large economy, reasonable population. Yes, we have a long
developed economy
and a developed economy. We have a long way to go. Even if we go by the Viksit Bharat projections, we will, in 2047, we will probably be where China is today. There's still a huge gap. But they will be more prosperous than we are today.
So the next slide is titled Returns Don't Travel the Same Across Currencies, where we are trying to see a chart where we are comparing Nifty in INR and Nifty in USD, which is an India ETF derivation, and gold in USD and gold in INR. So clearly what spikes here And what clearly comes out of the chart is gold INR being at the top.
Versus gold USD, right? So there's such a huge difference between the returns of gold in dollar terms over this period. So this period is from 2012 to 2020, 26. Okay. So gold apparently grew
157.
157% in dollar terms, but it grew almost 420% in rupee terms. Okay. So is gold more valuable in India than in the US? No, that's a wrong conclusion to come to. It's just that the rupee has been depreciated. Correct? So, because of which returns in INR far more than returns in dollar terms. And hence, if you have to look at how gold behaved every year over the last 50, 20 years, you'll find that there have been more occasions where it grew better in India than the rest of the world. In the US, it may not have made much sense to own gold, but in India, it did make sense to own gold.
That's as a hedge also, right?
Yeah, as a hedge, and because the rupee was depreciating.
Correct. We wanted a hedge.
Yes. We didn't know it was a hedge. We just bought it because it was shiny and nice, and it is traditional to do so. Only last couple of years, it's been fashionable to say that let's have gold as a hedge.
And we can see it 2024, the upswing year.
Yes, the sharp upswing in gold prices.
Especially last year.
It also started happening with the huge amount of uncertainty caused due to the Russia-Ukraine war, when Russian assets got seized and brought by America. And suddenly it dawned upon the rest of the world that the US could really confiscate anything they wanted, doesn't matter whom they belonged to. And we said, heck, it's better to own gold rather than own US treasuries. And which is why all the banks started buying up gold across the world. You can also see that how the Nifty has been behaving, right, Hiloni?
Yeah.
In USD terms.
Yeah, so Nifty USD is up 76% in the same period, where Nifty in INR terms have grown at 314%. A huge deviation.
So if you're looking at India from outside in, it looks very different now, inside out.
Yeah.
Isn't it? So for a foreigner investing in India, his returns were very different from what we experienced as Indians resident in India. And if you're expecting a lot of FII flows, remember they're looking at this blue line, not the green line.
Yeah, that's true.
And we'd better be more attractive in terms of returns. Yeah, I guess that will happen. But for many, many years, Indian returns were better than the US returns in dollar terms. It's only with the tech boom of the last few years that the US Max 7, Max 10 stocks started doing so well that they're indexed it better.
Yeah.
And they outdid India in terms of returns if you look a last 5 to 10 year period.
So on the third slide, we have your diversified portfolio might be concentrated, where we are seeing the percentage of market made up by the top 10 biggest stock in that particular country. So if you see what comes out directly is that Singapore has 80% of concentration on top 10 biggest stocks in their index. And then, we have seen Taiwan, we have seen Japan, we have seen China in the last few years. Taiwan's is at around more than 55%. China, same at 50%. US, again, as you were talking about Max 7 in the last slide, the concentration is 40% in the top 10 big stocks.
Yeah. So while we say that Taiwan is almost 50-60% made up of the top 10 stocks, within that it would just be TSMC.
Correct.
Okay. The rest of the 9 would hardly be any.
Yeah.
So same with
South Korea,
where Samsung and
Hynix,
some of these 3-4 large chaebols hold most of the concentrations, not even all 10. They hardly 3%, which 3-4 stocks which hold all this. So when we are really investing outside India for diversification, we should ask, by investing in any of these nations, are we getting diversification? We're just getting another couple of companies into the portfolio.
Yeah.
We may not really be getting diversification unless you're really buying a number of these countries.
Correct.
Okay. You should be buying US, you should be buying Japan, you should also be buying Singapore and Taiwan, XYZ. Okay. Then you get real diversification.
Yeah.
Just by buying any one country, I mean, the US stock market is the most popular
percentage of market share.
Yes. It's more than 60%. Close to 70% is the weight of US in the all country world index.
Yes. Correct.
So Just by buying US, are you getting diversification? Maybe not.
Yeah.
And this also is a stark reminder that many of the countries' indices are very, very concentrated. India is a rare country in that sense, where we have a number of sectors.
Yeah, not a one sector or theme is dominating the return.
Correct. Like you have the tech sector in the US or in Taiwan, Korea. Oh, India has a number of sectors that are firing returns, which makes it a truly diversified economy to be invested.
So the fourth slide is on growth and inflation dynamic, where we are looking at GDP growth and CPI inflation forecast for major economies. So we are looking at what was in 2025 and how has the estimate changed in 2026 and in 2027.
Yeah. One clear thing is that expectations of inflation across the world are higher than what they were.
Correct.
And part of it is driven by the crude oil price jumping up due to the conflict in the Middle East, which is now coming to a close.
Looks like.
So yeah, but even once it comes to a close, it will take a few months for things to come settle down. So we do expect that oil prices they have come down, will remain down, but not really go back to pre-war levels for some time to come. So it makes sense for inflation assumptions to be here as it is and come down much later. But what it would also mean that central bank policies will remain firm. You're not going to see interest rates coming down anywhere. In fact, Europe took it a notch higher, right?
Yeah.
So we will see firm interest rates, if not higher interest rates, in many parts of the developed world.
Okay.
And you'll also see that the emerging markets growth rates are far higher than the global market growth rates, right? So we are looking at a 2027, 4.5% growth rate for
For emerging markets. Yeah.
and developed markets only at 1.7% earlier and now 1.5% now. So you see their rate has fallen where for emerging markets there's no change in the growth rate.
Yeah.
4.5 old projection, 4.5 new projection.
Yeah.
Is the
Next China.
same. So we are going to be driving more of global growth than ever before and in a more stable fashion, I'm guessing. And inflation also, how does inflation look in emerging markets?
So old was 4 and now we are looking at 4.7 for 2026.
Yeah, ex-China.
Yeah.
Yeah.
And
And if you're looking at all emerging markets, you're looking at 2.6 earlier and 2.7 now. And for developed markets, it was 2.1, which is now looking at 2.2, out of which US is a higher one than Euro and Japan at much higher level of 2.6% inflation. So you're seeing much firmer Japanese interest rates than we have seen in the last couple of decades. And this is going to make a lot of difference for global investors and for Japanese investors. So for the first time, Japanese investors in the fixed income will be earning more than they have seen in the last 3 decades.
yeah.
Which also means that they would not be buying as much of global fixed income as they were earlier.
Yeah.
They were the largest.
We already saw that in the flows, right? In the US. But
They were the largest funders for US treasuries, among the largest.
yeah.
Now that may reduce going forward.
Yeah. And on the last slide, we have India's valuation premium has compressed significantly. We are looking at MSCI India versus MSCI World P and how the premiumization has narrowed over there. And the last 15 years, India has obviously been trading at a premium, right? And we had an average premium of 17% across. Now that's coming to 0. So the band is closing.
Yes. And so even if you compare with the MSCI EM,
Yeah.
right, where we used to have a very significant premium, it's almost, on an average, that's the average. Touched almost 125% premium in 22, 23, and now down to 32. So it just shows that since the premium is lower, there has to be some amount of mean reversion. Any large cycle you look at, there is a mean reversion element coming in. So you can see that once it comes down to 32, it tends back to the average, which means there will be buying coming in.
Correct. Correct.
And we regain our historical premium. Of course, India has been enjoying the premium. Again, why? You're a diversified economy. It is large diversified economy.
And growing.
We are of the fastest growing large diversified
Correct.
economy.
Yes.
So
And also in the couple of years, right? Last couple of years, our balance sheet fundamentals of the company's debt to equity has significantly come down.
yes, the fundamentals of the corporate sector have improved. The
Correct.
fundamentals of India also have improved.
Yeah. Yeah.
Because
And we have a stable government.
yes, and we have a stable government. So I'm sure that we will regain some of the premium that we have vis-a-vis emerging markets and the rest of the world, and that will happen through a lot of investors coming back into India. That's about it. Thank you. I hope you have enjoyed this first edition of Take 5 in this format.
Yeah. Thank you so much.